So in this video, we are going to discuss the chapter 10. I actually will be reviewing the chapter 10 for the upcoming quiz. So first of all, let's see what we are going to test in this quiz. So first one is the capitalization of cost, which costs are to be capitalized. So which costs are to be capitalized? It means that which costs are to be recorded as the cost of assets. So one thing that should be noted here is we need to capitalize those expenses that are one time in nature and that add values to the assets and that are not frequent. Okay, so let's see from our PowerPoint. So what should we do? So these are the costs. See, property, plant and equipment and intangible assets can be acquired by purchase, sale, construction, donation, business combination, exchange, lease, and initial cost of the asset would be purchase price plus all expenditures necessary to bring the asset to its desired condition and location for use. Okay, so the cost of equipment would include the purchase price, any sales tax, transportation costs, expenditures for installation and testing, legal fees for to establish the title, any other costs to bring the assets to its condition and location for use. The sum of the above costs represents initial amount to be capitalized, meaning recorded as an asset in the balance sheet. Okay, and the expenditure, there are two, a revenue expenditure and capital expenditure. So these expenses would be capitalized and these would be shown on the income statement. Okay, so let's see an example. See, in this example we can see that the purchase price 62,000 and freight 1,000, then its planned location, so plus 300,000 shipping insurance. See that the shipping insurance, this is one time. Okay, and machine had to be installed and mounted on a special platform built specially for the machine at a cost of 1,200. So after the installation, several trial runs were made to ensure proper operations. The cost of these trials, including wasted materials, 600. So think that the purchase price one time, freight and handling one time, insurance during shipping. See, during shipping it is one time. So we'll be adding a special foundation. This has been created only for the installation of the machine and the trial runs. So this is the total cost. Okay, so and then we will be discussing the asset retirement obligations. Okay, so let's see. So asset retirement obligations and existing legal obligation associated with the disposition or retirement of tangible long-lived assets. Okay, so let's have an example. It will help us more. So the Jackson Mining Company paid 1 million for the right to explore for a coal deposit on 500 acres of land in Pennsylvania. The costs the cost of exploring for the coal deposit total 800,000 and intangible development costs incurred in digging and erecting the mine shaft were 500,000. In addition, Jackson purchased new excavation equipment for the project at a cost of 600,000. After the coal is removed from the site, the equipment will be sold. So Jackson is required by its contracts, okay, to restore the land to a condition suitable for recreational use after it extracts the coal. The company has provided the following three cash flow possibilities for the restoration costs to be paid in 3 years. Think that these 3 years, you need to have the 3 years after the extraction is completed. Okay, so now the cash flow is 500,000 30%, 600,000 50%, 700,000 20%. So the company's credit adjusted risk-free interest rate is 8%. Okay, so we need to calculate the asset retirement obligations. Okay, so let's see how we will be doing that. So come over here. So this is how we calculated this one. So the first of all, 500,000 30%, this one. So 600,000 50% is 300,000, 700,000 20% is 140,000. So total is 590,000, and we will multiply this one with 3 years interest factor. Okay, so this is the present value of $1, n equal to 3, because you can see that this is the 3 years, so that is why n equal to 3, and I equal to I means interest rate is 8%. Okay, let me show you how to calculate. So let's see how to find the value, the present value of $1, where the number of period is 3 and interest rate is 8%. Okay, so let's go to the table. So here is the table. We can see. So first of all, we need to find the n, meaning number of years is 3. So we'll be running this way, okay, this way, and then 8% interest. So this is the amount. See, this is the intersection. So 0.7938. Okay, so we have taken the 0.79383. Okay, so our total asset retirement obligation will be this value multiplied by the present value factor. Okay, so we know that. And the asset retirement obligation you will be recording. So coal mine total cost after adding the asset retirement obligation with the total cost. So other cost, actually our total cost will be this one. So we'll be recording coal mine debit, cash credit, because we have given this amount of cash, and this is our liability, asset retirement liability actually. Okay, so that's the next one. We will be calculating about the lump sum purchase. Okay, so when we do the lump sum purchase, actually we buy different kinds of assets together sometimes. Okay, so assets have different characteristics and different useful lives. So in that case, so allocate the lump sum acquisition price among the separate items. Okay, so let's see an example. This is an example. The company purchased an existing factory for a single sum of 2 million. The price included title to the land, the factory building, and the manufacturing equipment in the building. Okay, so these are land, building, equipment, patent, inventories. These are the assets and the fair value of the assets and this. So total sum of total is 2,200,000. Okay, so what we do is we will calculate the percentage of the fair value in comparison to total. How do we do that? So we will divide this one by this total. Okay, and that is 15%. Okay, so let's see how to do that. See, can you see that? So this one divided by this one. This is the way we calculate the percentage. So 15%, meaning land value is 15% of the total price. Okay, and building is 25% of total price. Equipment 30%. Patent 20%. Inventories 10%. So total this 100%. So we will be allocating these 2 million to different assets. Okay, and now here's the way. So we have paid total 2 million. Okay, so we will be just allocating this 2 million. So 15% of 2 million is 300,000. 25% of 2 million is 500,000. In this way we have calculated. So okay, And now, finally, in case of interest capitalization, we have already solved some problems in our class. Okay, so I will show you again how we did that. Okay, see that in this example, so our construction loan is 10%, long-term note 9%, and long-term note 6%. So in this case, we have calculated the average accumulated expenditures. How did you do that? This is actually, this amount has happened, has incurred evenly throughout the year. See, evenly throughout the year. Okay, so meaning 6 million. So we have divided 6 million by 2. That is 3 million for 1 year. And interest capitalization, we have solved this one. Okay, let me show you this another example. It will help us to understand more. See that in this example, on January 1, 2018, the Shaggy company began construction on a new manufacturing facility for its own use. The building was completed in 2019. The only interest bearing, actually it should be interest bearing, not interesting. Interest bearing. Okay, the only interest bearing debt the company has outstanding during 2018 was long-term bonds with a book value of 10 million and an effective interest rate of 8%. Okay, so the construction expenditures incurred during 2018 as follows, meaning they did not happen evenly. Can you see that? So we have received the money on January 1. This one we have received March, July 31st, September 30, December 31st. Okay, so first we need to calculate the average accumulated expenditure for 2018. Okay, so now let's see. On January 1, we have received this 500,000. So we have used this one for 12 months. So 12 over 12. March 1, we have received 600,000. So we have, you see, we will be calculating from March. So March, April, May, June, July, August, September, October, November, December. So 10 months. So 10 over 12. And from July 31st, we are using this 480,000. So July 31st is gone. So we will be calculating from August. So August, September, October, November, December, 5 over 12. And September 30, September is gone. So October, November, December, 3 months. Okay, December 31st. So actually we have received the money on December 31st, and we are calculating how much, meaning how many months we have used this money in 2018. So we have received the money on December 31st, 2018. So it means that we did not use that money. So that is why 0 over 12. Okay, we did not use that money for a single month. So this is the total accumulated average actually expenditure for 2018. And then what we will do? So we will just calculate the 8% interest rate of this amount, and this is our interest capitalization. Okay, I think you got that. And now we will be showing the exchange of assets. Okay, so Zamtron company recently traded in an older model computer for a new model. The old model's book value was 216. The original cost 480 less. This one is the depreciation, and its fair value was 240. So the company paid 72,000 to complete the transactions. So how do we calculate it? Meaning recording. So we have received the new equipment 312. So accumulated depreciation, equipment old, gain on exchange, and cash. So I will prepare another video on these two topics. Okay. I wish all of you will have a good exam. Thank you.